the country's largest mortgage default insurer, which backs almost $500 billion in loans, says anti-globalization threats are an increasing fear, so it has added those concerns to its ongoing stress tests. Canada Mortgage and Housing Corp., which protects financial institutions in the case of consumer defaults and is 100% backed by Ottawa, said in a release Wednesday that it looked at anti-globalization, earthquakes, a steep oil price fall and a U.S.-style housing correction to see how its insurance portfolio would hold up. It did not look at a combination of any of those scenarios. The verdict is a U.S.style correction would be its worst scenario for its insurance program, with a cumulative loss of $217 million from 2017 to 2022, which would come on top of a need for the Crown Corporation to suspend its dividends to Ottawa. CMHC paid Ottawa a special dividend of $4 billion in June because of excess capital and issued a $240 million dividend in August. In all of its worst-case scenarios, CMHC would suspend dividend payments, which would allow it to keep its capital levels above what is required by the Office of the Superintendent of Financial Institutions. We seek out extreme, almost unimaginable situations and ask ourselves, what if? That is the goal of our stress testing, said Romy Bowers, Chief Risk Officer of CMHC, said in a conference call with journalists. Stress testing is not a forecast or any form of prediction. With trade wars a possibility, CMHC added anti-globalization to the list and found it could still make a $118 million from $20,172,022 despite the threat, once it stopped paying dividends. Without any threats, the Crown Corporation would have net income of $7.34 billion during the time frame. It's pretty clear there is a lot of anti-globalization sentiment across the world, so we thought it would be interesting to explore, said Bowers, on the call, in which she noted that scenario is the most severe because, although there would be a cumulative gain compared to a loss in a housing correction, net losses would increase rapidly in the later years of the 20,172,022 period. The anti-globalization threat assumes a 31.5% drop in house prices from peak to trough and a 15.3% unemployment rate. CMHC removed the potential for interest rate hikes even as long-term rates rise, and the Bank of Canada boosted its overnight lending rate twice since July, with some predicting further jumps before the end of 2017. Why did we not do the interest rate when we have that stock of scenarios? And we did look at it, but we didn't feel it was necessary to run it this year because we have a pretty good understanding of what would respond to the interest rate shock from our work last year, said Bowers. A key consideration for CMHC in all of its scenario is the minimum capital test MCT set by OSFI, which for its insurance program would jump from 172% under normal conditions from 20,172,022 to 181% under the anti-globalization threat. The MCT is the ratio of capital available to capital required. Below 100% MCT, an insurance company may no longer be allowed to write new business. A level below 0% MCT indicates insolvency. During its extreme scenarios, CMHC's decision to cut dividends from its insurance program would boost its capital requirements as it continued to make money but not pay it out. CMHC also looked at its securitization program, which includes National Housing Act mortgage-backed securities and Canada mortgage bonds, and found MCT requirements would hold up. Gmar at postmedia.com, twitter.com/iWallet.